Hey there, everybody. Welcome to Chart This with Dave Keller. I am your host, Dave Keller, starting a few minutes late. Thanks for hanging with me. Delayed because I was lecturing remotely to the Aggies at Texas A&M. So shout out to the students at the at Texas A&M, the business school there. I had a great discussion about all things technical, checklists, how to approach the markets. Hope it empowers them to make better decisions as they go on through their careers in the financial industry. Hope you guys are all doing well. We're coming to you from a beautifully kind of overcast and rainy Redmond, Washington. The baseball-sized hail we were threatened with did not end up hitting my area of Seattle, which I'm thankful for. We did get quite a bit of thunder and lightning, and actually in this area of the country, that is incredibly rare. We don't have thunderstorms for whatever reason, and my family misses them from being in the Midwest and the Northeast and getting them quite often. So it was actually kind of a fun evening, and luckily everything, at least in this area, was safe. So much ado about nothing at the end of the day, but we did have all the emergency equipment ready to go just in case. Talking about the market conditions, kind of an unch day, kind of a much ado about nothing kind of day. Yesterday was a big distribution day. Today, the market's averages finished lower, but not by much. I would say this sort of continues the theme we talked about yesterday, sort of a continued rotation to more defensive sectors. You're going to see a very defensive sector at the top of the leaderboard today. You're going to see some of the growth sectors toward the bottom. Also, energy, which has been one of the best performers here in the last couple of weeks, actually at the bottom of the leaderboard. So today feels very much like a digestion day. This is a general way that I describe. You have a big move in either direction. Then you kind of have that wait and see day where we kind of just digest what happened, set the stage for the next move. Tomorrow morning, of course, we have the latest PCE data. That is the Fed's preferred method of evaluating inflation and its potential impact on the consumer. So buckle up for what could be a fun Friday. As a reminder, tomorrow on Friday, we'll be doing an all mailbag episode. I've had some really good questions so far this week. A lot of good content to dig into. I hope you enjoy it. We'll also start with a brief market update, just checking in on how the market's played out tomorrow, particularly after the PCE day, and an eventful week. Thanks so much for tuning in live on Facebook, on LinkedIn, on YouTube, and on X. I'm so thankful that you're doing so. As a reminder, drop questions on any of those platforms as we go. At the end, I'll take a question or two before we wrap the live stream for the day. All right, let's look at how things played out here. So, red is basically the color we're going to talk about for much of this particular episode in terms of the movements in the major averages, but not a big down day, right? I mean, yesterday was a big down day. Today was sort of a lick your wounds kind of day. The S&P down below 5,700. We closed around 5,693. That's down 1/3% from Wednesday's session. The NASDAQ composite down about 0.5% to around 17,800. The Dow just below 42,300. That's down about 1/3% as well. So growth underperforming value, just as we interpret by those major indexes. Mid caps, small caps, all down as well. The mid cap S&P 400 index was down the most, but still only about 0.7% from yesterday's close. The VIX did drift higher, about 1/3 of a point, a third of a VIX point higher to around 1870. So we're still below that 20 threshold, and overall still in a low volatility environment, as I like to label it. Looking at the fixed income markets, we can see the 10-year point up slightly to 4.37%. The long bond yield is just about 4.7% now, and the 5-year point right around 4.1%. So we have kind of a general incline to the yield curve, certainly between the 5-year point and the 30-year point. The financial sector has been overall doing quite well, given the yield curve more normal shaped after an inverted yield curve for a number of years. Bond prices slightly lower today, about 1/3% lower for the TLT, which is a treasury bond ETF that we track. Dollar down slightly as well. Not a huge move in the UUP. That's the dollar ETF that we track, but overall weaker dollar, weaker bonds today. Looking at the commodity space, mostly positive and good up days for gold and silver. Gold managed to pound out another new all-time high, sort of driving above $3,000 an ounce and continuing. Here we're looking at the GLD, which is an ETF that holds physical gold, up about 1.3%. I do own the GLD in my accounts. The SLV is the silver ETF, up 2.6%. I actually think I own silver as well, but I forget. That's a position I might have kept for a little while. Crude oil prices basically flat for the day. And as I mentioned, energy stocks are actually down a little bit today. That's been unusual. Recently, energy has been one of the better sectors, along with the other the other value sectors, that is. Looking at cryptocurrencies, choppy and mixed, but Bitcoin up about 0.4% from yesterday's close, up about 87, up to around 87,300. Ether prices right around that crucial 2,000 level. I mentioned many times, big round numbers tend to be meaningful with cryptocurrencies. You can look at the charts and you'll see what I mean. They tend to gravitate to those major price points. Ether over the last 36 hours, we'll call it, testing that 2,000 level. The rest of the crypto space kind of mixed, to be honest with you, depending on which area you're going. So kind of reinforces that consolidation day or that digestion day, as I mentioned earlier. This was certainly a weaker day in terms of sector breadth. So you can see most of the S&P sectors were down today, 8 out of 11. The 3 that actually finished in the green, consumer staples number 1. That's right, consumer staples number 1, up 1.1%. Continuing to see some of those staple stocks, food products, random other names that had really good bounces and then pulled back here in the last week as growth stocks popped higher. A lot of them starting to turn a little bit further. So we've got consumer staples number 1 up 1.1%. Healthcare and consumer discretionary basically slightly higher from yesterday's close. And utilities and materials were basically flat on the day as well. On the downside, the sectors that lagged today, energy down about 1%. The XLK, which is technology, down about 0.9%. You have to remember, these are looking at cap-weighted ETFs. So the energy sector, a big chunk of that are the 2 integrated companies, Exxon and Chevron. Technology, it's 3 names that make up about half of that ETF on a cap-weighted basis: Microsoft, Apple, and NVIDIA. So XLK down 1% basically means the big names are probably down today. Industrials down about 0.5%. That's third from the bottom. So again, not a big directional movement kind of day. This is more of a choppy, sloppy, as someone mentioned in the chat, a whack-a-mole market. I'll take it. All right. Looking at breadth in terms of the advancers versus decliners, you can see that the main breadth that we look at, the New York Composite breadth, 56% up to 41% down. So certainly more stocks down than up. We saw that with the sectors as well, where most of the S&P sectors were in the red. What you have to remember is that the sector ETFs we look at are cap weighted, right? Those are cap weighted ETFs, really dominated by the biggest names in each of those sectors. Advancers, decliners, these are equal weighted measures. You're literally just counting the number of stocks that are displaying a certain condition, like are you above or below a moving average, or did you close up or down relative to yesterday's close? And so one of the benefits of breadth indicators is that they are all equal weighted, which means you can compare that to the cap weighted benchmarks and other things to just sort of get a different look on health or conditions in the equity markets. So more stocks down than up pretty much in every one of these. The most striking would be the mid cap index, was 61% down and 39% up. But a lot of these very similar, kind of 50%, 52 to 60% down and 40 to 45% up on the day. So more stocks going down than going up. We did see a little bit of noise in our market trend model through the course of this week. Through yesterday's close and earlier today, as I was checking sort of some mixed results on some of these. Again, as a reminder, this market model widget that they created for me a little while back, and thanks again to Stock Charts for doing so, allows us to monitor these market trend models. It does one check at the end of every day after the close, after the closing data is published. It does one check to just see if there's any change, and it updates it. I formally update my model every Friday after the close. And this is pretty much what it looked like as of last Friday. Earlier this week, with the rally from last Friday into this Monday, some of those short-term models had turned briefly positive. With today, they're moving back to the downside. Looking at the mega cap growth names, kind of mixed today, which is a little different, right? These have been kind of all up or all down, I feel like, on the average day here. But as you can see, Apple up 1.1%. That's the best performer of this bucket. Netflix, number 2, up about 2/3%. If you asked me, like, you have to own one of these stocks based on their technical merits, I would pick Netflix, hands down, no questions asked, until proven otherwise. That is clearly the best structure from a technical perspective out of all of them. And not a bad chart. I mean, if you look, it's kind of still making higher highs and higher lows, and very few of them doing so. All of these charts, I think, have some issues, even Netflix. But if I had to pick one, if you had to rank them 1 to 10, which ones are the least bad? Netflix definitely at the top of that list. On the downside, Broadcom, again, it's like the Sports Illustrated cover curse. The moment I added Broadcom to this chart list, literally that might have been the peak. We're just continuing to pound lower here, down another 4.1%. This week, Broadcom is one of those names failing to hold its 200-day moving average. The bear case for me right here is that more and more of these names also fail to hold their 200-day moving average. NVIDIA, speaking of which, down another 2% today. Alphabet, number 3, down 1.7%. By the way, we'll come back to this, but we talked yesterday about that 3-candle pattern, what's called the evening star candle pattern, which is where you have a run, an up day, a little day, and a down day, following through today, sort of in the direction you would expect. Further distribution on today's session. All right, let's look at the heat map. As a reminder, I do see some questions coming in. I appreciate them. Keep them coming as we go through the heat map, as we go through the charts. And at the end of the episode, I will take 1 or 2 questions before we wrap. Any of the questions we don't get to, we'll put in the mailbag, and maybe tomorrow's show we'll be able to dig into it a little bit further. Looking at the heat map, this very much looks like a digestion day, kind of a mixed bag of all sorts of different colors. This is one of those days where the extremes, like the barbells, kind of stand out, right? So like the big up days and the big down days, you can tell, and the stuff in the middle, it's kind of everything's kind of average. So the big green, the big red kind of stands out. So what stands out to you? I'll tell you. So first off, again, I mean, I'm struck as always when I see big names down a lot, because I know the benchmarks are dominated by Alphabet, Meta, NVIDIA, Broadcom kind of stocks. So when those names are struggling as they are on a day like today, that means the benchmarks have a low likelihood of being positive, because those guys represent so much strength. But note that some of the FANG names were actually up, right? Apple up about 1%. That's not a huge update, but at least it wasn't down. Microsoft, Amazon, Tesla basically flat for the day here as we're looking at it. Tesla was a noisy session, by the way. I don't know if I grabbed that chart, so we'll look at it here in a second. I'm going to grab this just so I don't forget to do it, and we'll come back to it. All right, let's see what else. What else stands out? Consumer staples, pretty much all in the green, definitely stands out to me. I mean, one of the the patterns that we've seen, I think 2025 has been all about certainly those conditions which are pretty common with major market tops, but also recognizing leadership rotation. By the way, did a podcast interview a couple hours ago with Craig Johnson, who's the chief market technician at Piper Sandler in Minneapolis. Just found out this is his 30th year at Piper Sandler. He's at one of those great technical analysis firms with a history of technical research in the brokerage community. Craig's been there for 30 years. We served on the board of the CMT Association a number of years ago, and it was awesome to catch up with him. We talked a lot about leadership rotation. He was pretty bullish in terms of how to navigate this sort of period. He was sharing a lot of data about the long-term, forward-looking returns after a 10% correction. So I will leave it to him. That episode will probably come out tomorrow morning, but as soon as we can get it out to you, we will post it on our YouTube channel and podcasting platforms. But check out that conversation with Craig Johnson, who's actually pretty good one. We talk about defensive sectors, and I would just point out that's been one of the changes we've observed here in the last couple of weeks. Defensive sectors like consumer staples and utilities and real estate have outperformed so far year to date. In the last week, as some of those growth stocks have bounced higher, staples have kind of come down a bit. But we'll see how things play out here today. It looks like a nice bounce higher. Something like Dollar Tree up a ton, Bunge, BG up pretty good. I mean, these are not great charts yet. I think they still have a bit to prove, and I'd love to see them break above resistance, but there may be continuing, sort of build momentum for a big base breakout to be determined. I would also note in the financial sector, most financials, again, not great. I mean, there's not a lot of great movements here, but I would note the payment processors like Visa and MasterCard. These are names that have been making new all-time highs going into January and then February, all pulled back along with a lot of other growth stocks into mid-March, but bouncing big time V bottom and reapproaching their all-time highs. That has been one of the stronger areas of the financial sector, along with exchanges, things like CME and ICE and others that have been pretty good, consistent uptrends. Banks like Morgan Stanley and Goldman Sachs kind of looking like Visa and MasterCard, except they're rolling over big time today and maybe making a lower high, which is a bit of a concern from a technical perspective. Honestly, I think that's it. I mean, the other thing that I would point out would be within the technology sector. I mean, when you think about, signs to look for me, I'm looking for signs that would validate a new downward leg for the major averages. And two things I would look for on this particular kind of heat map. Number one would be big pockets of red in sectors like technology. Technology has not been a great sector year to date. We had a nice counter trend bounce in a number of these, but we'll see if they're able to hold those gains. Today, you're seeing like Palo Alto, AMD, Workday, Arista, Microchip, all down pretty good amounts here today. The other thing would be defensive sectors. Today, consumer staples kind of an outlier in that it looks pretty good, but look for real estate, utilities, healthcare, and look for some more green in some of those areas for now. A digestion day. I think tomorrow could be a significant day to pay attention to. I don't know. I actually did grab Tesla. I knew I did. All right, let's go to the charts. Continue through here. So what happens on the daily chart of the S&P 500? So yesterday we explained in a little more detail this 3-candle pattern called an evening star candle. And again, what's really cool about doing a show like this every day is we can actually literally track the chart of the S&P day to day and highlight some of these candle patterns, see when they work, see when they don't, which they don't always work for sure. But just sort of reassessing the conditions from one day to the next, thinking about the short-term movements relative to the long-term. If you missed that, go to yesterday's episode on our YouTube channel. In the chart review portion, we dug a little deeper into the evening star candle pattern. So today's further down move, not a surprise. It really suggests the next 1 to 3 bars are more likely lower. So it looks like we're following through on that for now. For me, the fact that pattern happened right at the 200-day moving average is a problem. It also happened at the lower end of the shaded area, which is going back to this gap here from early November. Sorry, I was zooming all over the place from there. That's looking at that gap. So, once again, we're kind of trading up to that gap range, which did serve as support a number of times. We're kind of failing to get above those levels. So, the sign of a bear market is that bear market rallies fail to get above key resistance levels, right? A market that's in a full recovery breaks out and just continues. So 2 things I do in this environment. Number one, look to see if we can eclipse resistance. I would say we are not doing that just yet. The other thing, kind of an easier way, just draw trend lines, right? Like this one. This is a simple trend line, which I will leave on the chart so we can come back to it tomorrow. But this trend line is basically looking at the lows from mid-March to a week later in March and now late March. Today's low, perfectly touching that trend line. I was taught once is chance, twice is coincidence, 3 times is a pattern. I read that early in my career and I wrote it out and put it on my monitor at Bloomberg to remember the value of testing trend lines multiple times. This looks like we've tested it a 3rd time maybe today. Let's see. And when that trend line breaks, maybe that tells you this counter trend rally is maybe over. And if so, watch how quickly this looks like a bear flag pattern, which is a big move lower. You have kind of a parallel move, higher highs and higher lows on a shorter term time frame. Breaking below the lower boundary would basically suggest whatever this move was, you have a similar move, and that might get us down to that 5,100, 5,150 level we've been talking about. We'll see, right? For one thing at a time, but that's something that I'm certainly watching here. All right, looking at the VIX, and again, great conversation with Jay Soloff last week on the podcast. We released that over the weekend. I want to say Sunday or Monday. So make sure you check that one out if you missed it. We talked a lot about volatility, and so far now for the last couple of days, the VIX kind of pushing higher. The VIX drifted lower from early March to last week as the market sort of had this counter trend bounce off of S&P 5,500. It looks like we're getting a nice bounce higher this week in the VIX. VIX above 20 would be sort of a red flag for me, telling me we're probably starting that next leg lower on the S&P 500. So certainly something to watch as well. Weekly sentiment data comes out on Thursday. 2 surveys that we like to highlight. One would be the AAII survey. It was up this week. The other one's the name exposure index. That's the next chart we'll talk about here in a moment. I just want to point out that the AAII survey did actually get less bearish this week. It's been at full bearish levels for the last 4 weeks. We got down to below 60% bears for the first time since September of 2022. That was about a month ago in late February. Over the last couple of weeks, we've remained around 60% bears, and bulls have come down to around 20%. So that spread, a 40% spread from bulls to bears, is one of the more negative readings you're ever going to see. And it's pretty common that you have those readings at least viable bounces. The problem I have with this indicator, though, as a long-term indicator, is you often have further downtrends before the downtrend is complete. And that's, I think, the risk that we're experiencing right about now. But for what it's worth, actually getting a lot less bearish. Today, you had 27% bulls in the latest poll, down to 52% bears. That's still a 25% spread of bears over bulls, but it's a lot less bearish than it was even just a week ago. So what that suggests, a lot of bearishness on this initial move down, a little lessening here last week, over the last week, maybe some optimism as we bounced off of the lows. Certainly something to watch. And again, the more bullish that this gets, the more bullish it is, because recoveries usually involve, nice upswings in bullish sentiment as investors start to believe that we're having a recovery. I've highlighted this pink line, by the way, just to show where we're at relative to where we've been. So you can see where we're at. Where we're at right now is kind of average for 2022. And again, that's the challenge I have. I don't find these as particularly good timing tools. I would not ever run a fund called the AAII fund, and it's based purely on this. For me, these are indicative measures. These are descriptive that tell me about investor sentiment, but then I want to dig deeper into price and breadth measures to really define how the trend might be changing. Worth noting, in the name exposure index, another decline in this indicator. And this is a little different. That last one is looking at individual investors and asking, are you bullish, bearish, or neutral on stocks for the next 6 months? The name exposure index asks a group of money managers every week, what's your exposure to the equity markets? How much are you weighted to equities? About 6 weeks ago, this reading was above 90%, around 92%. As of this week's reading, it's around 58%. So that is a big swing, 35% swing from overweight to now a little bit underweight. This is below the average reading in my experience. So it suggests that money managers are actually fading this market here from mid-February to mid-March, not buying into this most recent bounce, but still sort of unwinding here. So something certainly to keep an eye on. All right, let's look at some individual stocks. We'll start with these couple. I actually just put an article on stockcharts.com last night talking about these 3 particular charts, if I remember right. I've written a lot this week, but I'm pretty sure that's what that article is about. Meta Platforms, number 1, holding its 200-day moving average. We bounced in about a week and a half ago, bounced up to around 630. This week starting to rotate lower, currently trading just above $600 a share. This is one of those I would set an alert and watch it closely, because if and when Meta breaks below 574 and gets below its 200-day moving average, this is one of those names that I think you really needed to hold the 200-day. If you're bullish, like, you need this kind of chart to start working again. If it breaks below there, I think this is a really ugly market very, very quickly, because once investors see that big established growth names like Meta aren't holding their 200-day, you got to find something else to grasp onto, and there's not much left, right? I mean, these are the names that are still kind of holding on. So Meta still above its 200-day, still okay. Amazon, big kind of question mark right now, kind of a yellow light on the old stoplight, because you can see we're trading right around. Oops, that's Tesla. Here's Amazon. We're trading right around the 200-day. We've been below the 200-day for a couple of weeks. We actually gapped above it about 4 sessions ago. We traded up to around 207. Now trading, the last couple of sessions have traded just below the 200-day, but closed above it. Again, this one failing to hold the 200-day going into the weekend would be a pretty negative sign as well. Tesla, just all sorts of sloppy, choppy as it approaches its 200-day moving average from below. I will tell you the chart of Tesla. Let's see, candle focus. Anyone know what pattern this one is? This might be a more obscure one. There's 2 ways you could label this. There's the easy way, but then there's a more obscure way I might label this if you know candle charts. If you know the chart, so number 1, we're in a rally phase, right? So we're in a primary uptrend, or we say a short-term uptrend off of the lows. So this is only a candle that pops up in a bull market phase. So you could label it two ways. One would be a shooting star candle, which is when you have an uptrend, you have the open and close near the lows, and then you trade higher. The other answer, Larry, watching on YouTube, well done. The gravestone doji, 100% correct. Bonus points, my friend. Well done. And Bull Bear Jeff, a couple of you. Good for you guys. Nice job. Knowing your candle patterns, the gravestone doji. A doji candle is when the open and close are right around at the same low, at the same level. You have minimal lower shadow, long upper shadow. That's called a gravestone doji, and it's about as ominous as it sounds. Usually would mean a short-term downside reversal. So again, over the last couple days, Tesla has shown a hanging man candle, which we talked about on Tuesday's episode, followed by a gravestone doji candle, all at the 200-day moving average. It's just not bull. I mean, it just is not bullish. From a technical perspective, that is a bearish short-term setup and suggests the next side down. So I don't trade on the short side, but this would be one of those technical setups where playing a short-term downtrend could make a ton of sense. Now, what's interesting is this is happening after the tariff news. It should be pretty good for Tesla, arguably on a relative basis, right? I mean, if non-U.S. companies made, with things done outside the U.S., that's GM with a lot of stuff happening in Mexico. It's something like BMW importing cars from Germany. Your car is going to be more expensive, right? If those tariffs go as what was just announced, that should be great news for Tesla, which isn't going to have to deal with that as much and shouldn't have. Now, they have their own problems with electric vehicles and all that sort of stuff. So I don't want to say that they don't have their own unique issues, but the chart is not telling me bullish at this point. Getting above the 200-day and having constructive breakouts above that resistance would be meaningful. But yeah, this is one of those times where in a downtrend and you have a rally up to a moving average, this is one of those, instead of buy the dips, it's sell the rips, right? It's sort of the opposite general way of thinking. That's how I would personally be thinking about that chart. Broadcom, we showed on yesterday's show, breaking below the 200-day moving average. And again, this is why we watch for that sort of move. I have a scan on stock charts that I run regularly for stocks breaking above their 200-day and stocks breaking below, just to find names like this where you're seeing an actionable moment. Now, when that happens on yesterday's session, we say, is there follow through? Is there additional move in that same direction? And today we definitely do. So I would say Broadcom kind of having a negative outcome here. So again, while a lot of these names have not really broken down significantly yet, the short-term signs I'm seeing are suggesting, further deterioration until proven otherwise. Now, not all charts are bad here. To finish up with the chart review, and then I'll take a question or two before we wrap. 3M, arguably still good. Now, it's not all great. And I'll tell you, there is one thing about this chart, maybe two things about this chart that concern me a little bit. But for the record, stocks like 3M, generally above two upward sloping moving averages, are pretty rare. It's another one of the scans that I run. It's actually a scan on stock charts. I'll show you in case you ever want to run it yourself. If you go to, let's see, charts and tools, sample scan library, go down here to, my friend Grayson Rose set up this one called something about moving average configuration or something. Where is it? It's totally not there. I lied. It might be up here. Let's see. Predefined group. Did I totally make up that this was it? Oh, no, here we go. Moving averages in correct order. So it's here under technical indicators, this section called popular bullish scans. Moving averages in correct order. This is a scan. You can run it right from this page, or you can edit it and add more stuff to it. But this is basically the 20-day exponential moving average is above the 50-day simple moving average. The 50-day simple moving average is above the 200-day simple moving average. Great scan to run. And you find charts like 3M, which have been above moving averages and just been in a primary uptrend. Great way to find charts in primary uptrends and charts in primary downtrends if you look at the inverse. So that on its own is bullish. I would tell you what concerns me about the chart of 3M, though, is the fact that we've hit resistance, right? So we made the new high in late January, right around 154, 155. We retested that level here in late February. We retested that level a couple days ago, and we kind of stalled out at 155. The problem I have on top of that is the fact that we have bearish divergences, right? So while the price is kind of stable, trying to push higher, the momentum is clearly deteriorating. And so that's more of a bearish sign. Think about baseball, because today is opening day, and good luck to my Cleveland Guardians and the local team here, the Seattle Mariners. I cheer for both, but I cheer for Cleveland first and Seattle second. I hope your team does great wherever you're at. Unless you're a Yankees fan, I just can't do it. I'm sorry. It's in my blood after being an Indians fan for so long and being hurt so many times. Having said that, hope you enjoy the season. Always a fun time of year to see the teams playing again. And I would say when you have bearish divergences like this, that implies we're in the 8th or 9th inning of an uptrend and not the 2nd or 3rd inning of an uptrend. So something to watch. Now, for now, it's still holding. All right, it's not breaking down much, but I'll be watching those swing lows in February and March to see if they would hold. Two more that I'll highlight. Capco Industries actually is an IBD name. This is a top-ranked name according to their composite rating. Someone had asked about not Market Smith. What's it called now? Market Surge. Market Surge is the new labeling. I'm not a fan of that branding there because it's just so confusing, because it's close enough to the old name that I can't remember it. But whatever, Market Surge, it's fine. Great platform. I've used it for many years. A huge fan of the IBD methodology, and have enjoyed going on the IBD podcast and IBD Live with those guys. Really, really wonderful group of market practitioners. This is a name that scores well. Is sort of inspired to go back and dig through some of the IBD rankings. And Capco rates pretty well, right? It's in the top decile, I want to say, on the composite rating. But what's good about CVCO, it's kind of building up for a potential breakout. And this is the type of name, again, above upward sloping moving averages, kind of similar to the 3M chart. But I think these charts look really good if and only if they break above resistance, right? So the IBD methodology calls that a buy point, I think. Breaking above a buy point. I think of this as like a basing pattern, and breaking above 540. So this is the type of name I probably wouldn't take a shot today. I put it on a list and set an alert for 540. We pop above there. That's the time to take a look. So something to watch for sure. All right, finally, Lululemon earnings. Not a lot of earnings. We're kind of in that quiet period before the next earnings season starts. We're about 2 weeks out. Mid-April through early May is when that'll be something we talk about every day. But for now, it's random consumer names and others. Lululemon reporting today. So we'll look at the post-market trading here in a moment. I would say the technical setup's not bad. You have this gap here from December, which you call an exhaustion gap. That's when you have a big trend higher and then a big jump, a gap higher, and then we kind of hold off a little. We don't go up anymore. And that suggests the end of this move. And you can see we didn't go much higher than 420 after that point. We then broke lower. And now we're bouncing off of the 50-day moving average. So I would say from a technical perspective, the risk reward isn't bad as long as you consider the 200-day as a stop. And so this is one of those where taking a shot, although taking a shot into earnings, I would probably not do. I'd wait to see what happens. But from a technical perspective, you're kind of saying, I want to play the move to retest the January high, and I'll limit my risk to the 200-day. That's not bad. That's not a bad setup, I would say. But let's see what happens on the after hours trading. Ooh, down a lot. All right, so we're down to 308 today. We're down 10% in the aftermarket. So here's the other side of the coin, which is it looks like what's happening. So it's currently in the aftermarket. We'll see what happens tomorrow. But after hours, after the earnings report, after the earnings call, we're getting down about 10%. To 308. We're kind of currently right around the stuff. So we're right around the 200-day moving average, a little bit below, right? We're kind of right down here. So below the 200-day, retesting those March swing lows. So the reason why I highlighted Lulu to my premium members over the weekend is because this week you look at Lululemon as an example of a luxury retailer. I mean, these are expensive, yoga pants and other things that they have. And I know they have other stuff, but it's athleisure kind of stuff. So are consumers still paying for premium things like this, or are they starting to see signs of a slowdown? What about inflationary pressures and interest rate? How is that impacting consumer behavior? Between Lululemon today and the PCE tomorrow, I think we'll have a couple data points. Most recent data points have been not great about consumer sentiment. They've been suggesting slowing sentiment, less optimism. I would say Lulu missing earnings today. That would be another check in the uh-oh column for consumer sentiment. So overall, interesting technical setup. But if we close tomorrow below the 200-day, I don't think that's a great chart anymore. All right. I appreciate some of these questions that are coming in. Let's take a look. Someone mentioned Bull Bear Jeff. Thanks for the comments. You mentioned Musk tweeted tweeted that his foreign parts would be more expensive. Yeah. So I mean, the problem is the reality is with the modern auto industry and even the EV part of it. I mean, things come from a lot of different places. Is sort of how things are done at this point, which means tariffs just have ripple effects. And I think that's the tariff risk right now. The headline risk, as I generally call it, is a challenge, but particularly now, the headline risk is pretty significant with tariffs. And again, we'll see how things are actually implemented here over the next week. April 2nd is the big day coming up next week. So we'll see what sort of actual tariffs are implemented. But again, that is real potential. Certainly, the market is not taking that as optimistic. Lee, thanks so much for watching on YouTube. You said, I like to compare a regular kind of traditional MACD 12, 26, and 9 with a shorter model 5, 13, and 5. I see what you did there with Fibonacci numbers. And who I look at, all the Mag 7, the near term doesn't look rosy. Can you comment on the usefulness of this approach? Interesting. All right, let's take a look. So we'll look at like an NVIDIA, and you're saying MACD with the traditional settings. That's what that's going to do. And then you're doing like the same indicator, but shorter term numbers. So what these three numbers mean, again, different charting platforms do this differently, but MACD will tend to have three parameters. The first two are the exponential averages that make this black line called the MACD line. And that's the most important comparison you're making. You're basically looking at the spread between the 12-day and 26-day exponential moving average. So with your quicker setting, you're comparing the 5-day to the 13-day. So those are shorter term. It's going to be more sensitive, but also more volatile. And then the 9 there is the signal line, which is this black line, or the red line, how much you smooth out the MACD line to get a signal, right? So you have a lagging version of it to look at crossovers, and you're looking at just a shorter version there too. All right, so we'll zoom in a little bit. So what do I think of this approach? I mean, so there's always a trade-off, right? I mean, I think with indicators, you have to remember with any technical indicator, you have a couple different levers you can pull. You can change the data you're looking at. So instead of a daily chart, you can look at a weekly chart or an hourly chart or a 5-minute chart. And so you make the timing, the period higher or lower, and that will certainly affect the indicators, of course, because you're bringing in different data. Or you can make the indicators, more or less sensitive or more or less lagged to the data. So the bigger numbers, the more data you're using to smooth it out, the smoother the indicators are going to be, which means you have less noise, less whipsaws, but also less signals. And so the right answer is it depends on what you're trying to accomplish. If I'm a swing trader and I'm just trying to pinpoint some of these little moves in NVIDIA, I would not use 12, 26, and 9. I'd probably use something more similar to what you're using, like the 5, 13, 5. I don't think that's a bad one to start with. And then the question is just, how does it work? Do you get a lot of false signals? And if you get a lot of whipsaws, meaning you get a signal but it doesn't work. If that happens too often, you make these a little bigger because it's gonna smooth it out a little more, make it a little smoother and a little less sensitive. It really depends on what chart you're looking at and what kind of moves you're trying to capture. Same thing like with RSI. The default is a 14-day RSI, but if I'm a swing trader, I'm probably using like the 9-day, maybe even the 5-day. To look at shorter term swings, and then you can actually use it as more of a short term oscillator. So the way that you use indicators really should be optimized for the type of trading you're doing. I always think, look at the chart first, kind of identify where you're trying to, what's your ideal entry and exit point, reasonably so on the chart, and then back into it, designing indicators and techniques that would help you identify those levels. That's probably what you want to use using forward. So it's kind of using a back testing approach, seeing what's worked well, because certain things are more or less volatile, which means the indicators may need to be a little more or less sensitive depending on what types of moves you're trying to capture. That'll do it for today, folks. Thank you guys so much for tuning in. Again, apologize for the late start, but I want to thank my friends at Texas A&M. I'm actually going to be lecturing to another section of their technical analysis class here in a few moments. And we'll be good to chat with them. But thanks so much, guys, for tuning in. Thanks for the thoughtful questions. Tune in tomorrow for a brief recap on the markets this week, but also a Q&A going through some of the great questions we received. I'll capture a couple of these and throw them in the mailbag as well. For Market Misbehavior, I'm Dave Keller. Have a fantastic night. And remember, It's always a good time to own good charts. Take care, folks.